Not yet. Okay. There you go.
Welcome, everybody. Welcome to the show. Welcome to Jason Hartman's live stream. We are here with Jason, and we are going to answer all of your questions. Well, Jason is. And we're going to talk about the taper tantrum currently looming on the horizon and many, many other things. So how are you, Jason?
Doing well. Thanks, Ashley. It's good to see you here every Sunday morning. Of course, in addition to throughout the week, but definitely great to see you here. So I sent you a quote this morning, and I'd like to share that quote. Do you want to share that quote? Isn't that a good one?
It is. It is a very good one. I appreciated that. So you sent me a quote, and it says, "Don't let the opinions of the average man sway you. Dream, and he thinks you're crazy. Succeed, and he thinks you're lucky. Acquire wealth, and he thinks you're greedy. Pay no attention, he simply doesn't understand."
That is just such a great quote. The first time I read that, I was 17 years old, I think. And it really does make a lot of sense, especially in this environment, Ashley, where as we talk about often, you and I, we have this terrible sickness going around, the sickness of entitlement. And it especially affects, I'd say, the millennial generation. And you can't blame them, because they were the most catered to generation in all human history ever.
Yes.
This entitlement attitude is really an attitude of jealousy to an extent, if you boil it down. And the most important ingredient in success is not learning how to invest, or how to be an entrepreneur, or how to be a great singer like you, right? It's not the how to. What the how to might to some extent get you your desired outcome. It might get you that money, that success, that promotion, that opportunity with that new client, that new deal, right? But it will never create an environment where you can maintain success on an ongoing basis. The secret to getting it and keeping it is the right mindset, the right attitude. And that is just so important. I remember, again, I got into this stuff mostly when I was about 17 years old, but really a little bit before that. And I remember Earl Nightingale, the late, great Earl Nightingale, who was this famous speaker and teacher on success. He wrote, or not wrote, but recorded a record album. Yes, a vinyl record, Ashley, I'm not kidding. And, that would be good to buy. I should find that thing and buy it somewhere, maybe on eBay, because that should be a hugely valuable collectible. And The Strangest Secret was the name of it. And the strangest secret, according to Earl Nightingale, was we become what we think about. Now, he didn't think of that. He got it from Napoleon Hill when he read his book, Think and Grow Rich. But Napoleon Hill wasn't even the originator of it, because before Napoleon Hill, there was James Allen, who wrote this great little small book called As a Man Thinketh. The subtitle being, As a Man Thinketh in His Heart, So Is He. But James Allen wasn't the originator of this. It goes way back to the Bible. That was really the original teacher of this idea. Now, more recently, it was popularized maybe 15-ish years ago by The Secret. Maybe we've all heard of The Secret. That was this short film that went around, and there was a book. It was, a video that was played on the internet, passed around a lot. But this idea that we become what we think about, that we move in the direction of our currently dominant thought, is incredibly important to success. And it's more important than any of this how-to stuff that we help people with. How to invest, how to find a good real estate deal, how to evaluate a good deal. Certainly, the tool is important, but that's just the tool. If you have a a tool like a weapon, right? Say you have a gun in your hand, right? Well, if you don't know how to shoot it, it's not going to do much good, right? You might get lucky once in a while and hit the target down the target range, but the likelihood is not high. And that mindset, that success mindset, is just so critically important. And that's why I love this quote. Let me just repeat it one more time, if I may. Don't let the opinions of the average man sway you. Succeed and or dream and he thinks you're crazy. Succeed and he thinks you're lucky. Acquire wealth and he thinks you're greedy. Pay no attention. He simply doesn't understand. And that is so true. That basically is a story about jealousy. And what is jealousy but really entitlement? In another way, it's saying like, well, they don't deserve that. I should have had that. I should have had their success.
Well, you just got lucky, so you're just lucky. You're just lucky.
Yeah, just lucky, right?
Like maybe that you really worked hard for that. Completely out of the equation. You're just lucky.
Yeah, no, you're absolutely right. And as Earl Nightingale always said, luck is what happens when preparedness meets opportunity. And I think it was, I don't know who said this other quote, but luck is the word we use to describe the successes of people we don't like.
Yeah, nice. Yeah. When you started Empowered Investor, was that what you had in mind? Was teaching that the mindset is one of the most important factors, if not the most important factor to our success?
Certainly it's important. And that's not all it's about. I mean, most of our content is geared around the technical aspects and the strategic aspects and the tactical aspects of investing and personal finance, and how to make money, how to keep money, how to protect money, how to manage money, how to manage properties, etc. But I tell you, and this is where I don't think I even said this. I started talking about Earl Nightingale. You know me, I get off track. But Earl Nightingale said, to ask what is the role of attitude in success is like asking what is the role of H2O in the Pacific Ocean. Right? It's a pretty big deal.
Yeah. Yes. Well, hello, Gabrielle from Quebec. I love Quebec. Great.
Quebec City is so beautiful.
It's a wonderful place.
Ashley, that is like a clean version of Paris. Paris is dirty, and Paris is a bit of a disaster. But yeah, Quebec City is so clean and beautiful. It's just gorgeous. What a great city. And even Harry Hunter comments, Quebec is such a lovely city. I always enjoy spending time there. Yeah, me too. Let's go there sometime soon. It's great.
Very nice. Very nice.
Love it. Yeah, absolutely. Okay, so today you want to talk about the taper tantrum, don't you?
Well, I would like your explanation of the taper tantrum. Because every time I turn on the news, I just keep hearing this word, tapering. Is the Fed going to taper? The Fed is talking about tapering. So, what does this mean?
We will talk about tapering. And I must admit, I wanted to bring have a little watch party, but I don't have the video ready. So let's jump into something else. We cue that up. Okay, I'm going to get that ready for later in our talk, because to understand the tapering, I want you to see this first and do a little watch party. I always love to watch TV with our people.
Oh yeah, of course. Of course.
The new version of TV is really not TV. It's it's YouTube or some other video platform.
What did we do before YouTube? Sometimes I wonder.
Absolutely.
People are tuning in and watching us. Let us know. We've got one from Jacksonville. Very nice.
Let us know where you're located, everybody.
Look at it. Harry Hunter. It comes down to today's favorite line I hear constantly. That's not fair.
Yeah. Oh, it's not fair.
It's not. Life's not fair. That's part of it. That's part of the challenge. Part of the fun.
Grow up. It's not fair. There are so many instances of unfairness. It's
of course
impossible to even count them, isn't it?
No.
Yeah. Good stuff. Okay, so Ashley, let's talk about what's on your agenda first, or And I'm just getting this ready here. I'll be ready in a moment. It won't be long.
Absolutely. Okay, so first, before we get to some fantastic really interesting audience questions from last week and from YouTube this week, I would like to ask my trivia question, which will be revealed at the end of our live stream. All right, so let me screen share here.
Okay. Oh, okay. And go ahead and share, Ashley.
Okay.
Are you?
Mm-hmm.
It's not working. Oh,
there it is.
technology. Okay.
All right, that's okay. You can put it up there.
Yeah. Okay. All right. I will. Okay. So, so first off, of course, our live event is coming up in Orlando, Empowered Investor Live, September 10th, 11th, and 12th. We're super excited about this event. Ashley's been helping us hire our entertainment for Saturday evening. So that's going to be great. So join us for Empowered Investor Live in Orlando. Orlando is a great location because it's just super easy to get direct flights, inexpensive flights from really anywhere in the world. I don't think we'll have the international audience we usually have at this event because of all the travel restrictions and so forth. But people fly from certainly all over the country, from Canada, sometimes from Europe, Asia, Middle East, everywhere, Africa, to our events. And even down under Australia, New Zealand, we've had before as well.
That's amazing.
Join us for that. You can get your tickets at empoweredinvestor.com. Tickets at empoweredinvestor.com. And wouldn't it be nice to get out of the house, folks, and go somewhere and go on a trip? And how about going somewhere where you can make a vacation out of it? And by the way, I must tell you, Ashley, I spoke to our resort hotel where we're hosting this the other day, and they said that a whole bunch of people are booking longer stays because we see the nights rented in the room block because we have a discounted room block for only $169 a night, which this is a fantastic, beautiful venue. This hotel, I just love this hotel, and it's a resort. It's got just beautiful pools and just everything. It's just gorgeous. It's a gorgeous property, and they said that people aren't just booking for the typical 3 nights or 4 nights to come to your event. They're booking more nights, more hotel nights on either side of the event because they want to go to Disney World, they want to go to Epcot Center, they want to go to Universal Studios, or they just want to relax at the pool for an extra day. That opportunity is there. So empoweredinvestor.com, get your tickets and join us for that. And you will be emailed the hotel booking link, the discount booking link, as soon as you purchase your tickets. So check it out, empoweredinvestor.com. All right.
What amazing opportunity to network, to be with like-minded individuals. No man is an island. So why not spend some time with some people who see things as you do, can help you build a network.
Couldn't agree more. Like-minded people who have an alignment of interest and are there to help you with your success, as well as all of our speakers. We fly people in from all over the country for these events, and we just got a fantastic event lined up. So I'm just super excited. It is our first live event in almost 2 years. That's how long it's been. Yeah. The COVID thing just caught us at the wrong time. We had an event a few months before it, and then there were no events for a while. So we really look forward to seeing you there.
Long overdue. Great. Oh, we have some audience members from the west side of Washington, California, near Yosemite, California.
Yosemite.
Yosemite, I said it wrong.
Yeah,
I thought it was
love Yosemite. It is Yosemite.
Oh, it is. Okay, it is.
Yeah. Look at when my mom talks about that famous home improvement store, Ashley.
Yeah.
The one, Home Depot.
Yes.
She likes to call it Home Despot.
Home Despot. Well,
just a little humor,
Yeah, very nice. Hello from Pensacola. Oh, Pensacola's beautiful.
Yeah, I just sold one of my properties in Pensacola area.
I love that side. Houston. Greetings from Kathmandu, Nepal.
Wow, Kathmandu.
Hello. Incredible.
That is the furthest away person. What time is it in Kathmandu? I want to know.
Or at least
Make a comment. Tell us what time it is there.
And south of St. Paul, Minnesota. Very nice.
I think that's a Bob Seger song, you know. I'm gonna go to Kathmandu or something. Bob Seger, right? Is that Bob Seger? I don't know. It's an oldie but goodie. All right. You want to get on with the question here?
Yes. Okay. So we've got some interesting questions, and this first one kind of just ties into what we were just talking about. Jessica Contreras says, "I'm having trouble trying to figure out if this is a good time to sell a rental property to pay off another property to gain a sense of security. Do you have any insight on this? Thank you."
Oh boy, you asked the right person, Jessica. You asked the right person on that one, and I want to explode your beliefs here, folks. That the security is not in paying off your mortgages. The security is having a large mortgage. I know it's counterintuitive. I know some people don't get it, but that's why you're here. You are here to be better informed. Look, I want everybody to understand you never own a property free and clear in the United States or even in most of the world. The vast majority of planet Earth, every country, jurisdiction, government, municipality, whatever, has a perpetual lien on your property. It's called property taxes. So you never own a property free and clear. It is 100% impossible to own a free and clear property. And if you have a homeowners association, they also have a perpetual lien on your property. And the lower your mortgage balance, the higher your risk. All right? Understand that when there is a natural disaster, a pipe breaks, even not a natural disaster, you know, a pipe breaks, right? And floods your house. A hurricane comes along, a tornado, a fire, whatever. Your lender will look to your insurance company to protect their collateral for that loan. And if you do not have a loan or you have a very low loan balance, there is nobody there to fight for you with your insurance company. The legal cases are riddled with insurance bad faith. Insurance companies love to collect premiums, but they don't like to pay claims. So why not have a partner, if you will, in your investments? And that partner is your lender. Your lender becomes your partner because they have an alignment of interest with you. So they will go to bat for you sometimes. I mean, I can't guarantee they will, but it's in their self-interest to go to bat and fight with your insurance company to get them to pay a claim if there is a big claim. Whereas if you have all the equity and you've paid the property off, there's no one there that has an interest aligned with yours. It's just you. It's little old you. So do you think your insurance company is scared of you? They're not. They are scared of the battery of lawyers that Bank of America has. Okay? And they will be much more likely to treat you well and pay your claim if you have a high loan balance. So the best protection is a high loan balance because of possible insurance problems, insurance claim issues. But the bigger and better and more important reason than that is that the lower your loan balance, or if it's a zero balance, you actually become a target for foreclosure, predatory foreclosures. What do I mean by that? Okay, let's take this example. Let's say that any big lender has a portfolio of 10,000 mortgages. Those are assets to them because they receive income every month on those mortgages, those 10,000 mortgages. Well, guess what? If half of that portfolio is in default, say it's a really bad economic time, and like it was during the Great Recession. And during the Great Recession, a lot of people, millions of people were defaulting on their mortgages. And when they default, the lender starts analyzing their loan portfolio. and they say, okay, we've got a portfolio of 10,000 mortgages we own. And of those 10,000 mortgages, 5,000 are in default. They might just be 30 days late. They might be 90 days late. They might be 6 months late without making a payment. Okay, our analysts need to go and evaluate the delinquency portfolio. So, of our non-performing loans, tell us what the loan to value ratios are on those properties. And the analyst will come back and say, okay, well, of the 5,000 loans that are delinquent, maybe 1,000 of those loans have high loan balances where they have less than 20% equity in the property, right? That's not very high, but I'm just using an example. And then the next tranche has, maybe 2,000 of them, or wait, what did I say? 5,000 in default. Yeah. So another 2,000 of them, maybe they have 50% equity. So, they've got really low loan balances. And then the rest of them, say, for example, they're paid off and they're they're not going to be free and clear because otherwise they wouldn't have a loan. Okay, let's think here. I need another cup of coffee, folks. Someone get me a coffee and send it over. So say the rest of them have really low loan balances, only 30% mortgage and 70% equity. Well, what is the lender going to do? They're going to go to the people who are in default, who have really high loan balances, very little equity, and they're going to send them a letter or maybe even reach out from their call center and call them and say, how can we help? Do you need a workout, a loan modification? Do you want to sell the property? Can we help you and do a short sale and help you sell it and relieve you of some of the loan balance if you'll sell it, a cooperative short sale? Mm-hmm. But the people who have equity, a lot of equity, they're going to say to them, look, you better pay or else we're going to foreclose. Because the lender can feel very confident that if they foreclose on those people, they're not going to take a loss because there's a lot of equity there, a big equity cushion to protect them from that loss. So it's counterintuitive, but the best insurance from economic disaster or recession or natural disaster or property disaster like a broken pipe or inflation, because I teach inflation-induced debt destruction. That's the third thing. The best protection is a high loan balance. So, Jessica, do not pay your properties off. Mortgage them, follow my refi till you die plan, and extract equity from the property and use that equity to buy more properties or get control of that cash and keep it in the bank. You'd be better off keeping it in the bank, which is the worst option, by the way, okay? Because it gives you no return, than you would to keep it in the property. Think about it. At least, look, in a long-term CD, certificate of deposit, you might earn close to 1%, which is nothing. It's terrible, right? But say you did a 5-year CD and could get 1% on that money. Well, guess what you get in the property? You get 0%. Your property does not pay you interest on your equity. The whole idea of return on equity is a myth because the property will go up in value or down in value, and it'll produce the same amount of income, meaning the gross rent, regardless of your loan balance. And right now, mortgages are so cheap that you should stock up on that mortgage. It's an asset, not a liability. So that's what I'd say. But one other thing, you question whether you should sell a property. And I don't know where that property is or how it's performing. If it's in a cyclical market with bad rent to value ratios, with low rent to value ratios, you really should consider selling it, doing a 1031 tax deferred exchange. I personally am doing 2 of those right now with my portfolio. And I'm probably going to start a third 1031 exchange for myself this year. That'll be the most exchanges I've done in any one year. I typically maybe do 1 a year on average, but this is a lot for me. This is the year of the 1031 for Jason.
Yeah, yes.
Yeah. But yeah, reach out to us, Jessica. We'll be happy to assist you with a free portfolio makeover. go to jasonhartman.com. Our investment counselors will be happy to assist you.
Okay, great. We have a question from one of our audience members right now. 1118, Chris Barton.
Okay, we're not going with Mr. Ribeye, huh?
We will in a minute. We will
okay,
get
let,
to
let me get to question or comment 1118 from Chris. There we go.
Yes. When accessing future rental prices, what percentage of the area's median income do you use to calculate the monthly rents?
Well, Chris, we don't calculate rents based on median income. We calculate them based on comparison. So, rent, I mean, we want to get the highest rent the market will bear, obviously, right? So we just look at comparables, and we look around, we see what's available for rent and what has previously rented recently, and we say, okay, I'll give you an example of why in this market the available for rent inventory is so important. One of the buyers on one of my own properties that I'm exchanging, I'm doing a 1031 exchange on this property, we're re-tenanting that property for him. So he's buying the property from me. I'm actually the seller on this one, and we are going to get the tenant out, redo the flooring, paint it, update it a bit, and then they're buying it. They're going to take it over with a brand new tenant. And the rent for that new tenant will look nothing like the previous tenant, because many times in this market, rents have increased so much and so quickly that usually the goal is to keep your tenants and to reduce tenant turnover. But in a market like this, a lot of times it's much better to just re-tenant the property and get a new tenant, because the tenant that you have now, who has maybe been there for a few years, and as a landlord, you haven't been raising the rents enough. Look, I'm guilty of this too, folks. You're not the only one that's not raising your rents as much as you should. And a lot of times we get a little lazy and we don't look around and we don't see what else is for rent. But Sarah, one of our investment counselors, looked up for him yesterday the rental comps. And in the whole city where he's buying this property from me, there are literally only 3 properties for rent. There's just nothing. The inventory is so low. And the rent on that property, once it's got new paint and flooring, maybe $10,000, not expensive, okay, is going to increase maybe 40%. You can't do that with the existing tenant. The existing tenant usually is someone who's been sitting there for several years, and they've had moderate rent increases. But we're in a whole new market now, folks, where rents have gone up dramatically. And a lot of times you just need to start with a fresh new tenant. So to answer Chris's question, median income is not the issue, because median income, I mean, it's good if there's a high median income in a market, obviously, but there could be more expensive properties and less expensive properties than your property. Your property is going to rent based on comparison and based on scarcity. What else can the tenant get? Looking at available rentals on the market, and probably, if you're in one of our markets that we recommend, there's not going to be much, because the rental market is really strong right now.
Okay, great. Let's go down to Troy Green, 1127. When equity stripping, what percentage of money should remain in cash versus reinvested in more properties?
Oh, Troy, that's a great question. So you always want to have a cash reserve of at least 4% of the value of your property or portfolio on hand in cash, not invested in anything risky. This is just cash in the bank for emergencies, vacancies, surprise repairs, tenant turnovers, whatever. Okay, 4% of the value of the portfolio. So, for example, if you have a portfolio that's worth $2 million, you want to have about $80,000 set aside in cash available for emergencies. Now, the larger your portfolio, the less you need in reserves. So, example on that, on $100,000 property, just say you've got a cheap property, it's 100,000. You want to have $4,000 set aside, right? But the larger your portfolio, the less you need in reserves, because you're going to have what's called the law of large numbers working in your favor. So you're unlikely to have disasters all at once in every property, right? Because you have the law of large numbers, which is basically one of the principles casinos operate on. The law of large numbers will work in your favor because you're more diversified with more doors, more tenants, more properties. Less. But I said at least 4% when the portfolio is small, but you don't want to have too much money in reserve either. Because remember, if there's a lot of cash in reserve, that cash is not working for you. That cash is uninvested. It becomes lazy money, sleepy money. You want to invest your cash so it is working for you. And look, when you get a few extra bucks, this investing your cash thing is actually difficult. It's a real problem. It's a good problem to have, but it is a problem nonetheless. And I'll be the first to admit that unless I want to be a little more reckless, it's sort of hard to deploy money. It's in things that you really think are good and safe and will get you a high return. So you may have too much cash on the side, but it's always a challenge to get it deployed. And you want your money in the game where it's working for you as much as possible. Yeah,
great. Okay, let's go back.
And as long as you have that 4% in cash reserves, reinvest the rest and buy more properties.
Okay, let's go back to our slides.
All right.
For another question from last week. So, Mr. Ribeye.
What a name.
I love it.
Do you think Mr. Ribeye likes steak?
Maybe. Yeah. The real kind, not the fake meat kind.
Do you think Mr. Ribeye is a vegan?
Highly doubtful.
Ashley, do you remember that Seinfeld episode when George was trying to be cool and he wanted his nickname to be T-Bone?
Oh, yes, I do. Yes.
Very
cool. Yes. Okay, Mr. Ribeye writes, so if I'm 33 and I have enough reserves, sounds like I just need to keep buying A and B class real estate until I'm 45 to 50 years old, then ride the appreciation and wealth compounding.
Yeah. Yes. I mean, look, we all will have different occurrences along the way. We'll have different things where we get lucky, and we'll have other things where we'll have bumps in the road and problems, right? And so these things will either add or subtract from our wealth. And then we all have a different number, right? We all have a different goal. How rich do you want to be, right? It's a great question to ask. and how much money can you use in one lifetime, right? You don't want to leave too much to your kids because you're going to ruin them if you give them too much money, right? Especially if they're young. It's a different the answer to that question, Mr. Ribeye, is different for everybody. It sounds so funny saying that. Yes, Mr. Ribeye. Yes. That could be a good brand of like steak sauce.
Mr. Ribeye.
I think I just thought of the big zillion-dollar idea for you right there. Yeah. So, but that's true. Buy as many properties as you can and ride the wave and let time work on your side. I have considered kind of scaling back myself, because I've been doing it a long time. I've made a ton of money, and I just am trying to deploy some of my own capital into things that don't make me busier. But every investment requires attention, folks. It's just the way it is. Whether it be even a bank account, a stock portfolio, real estate, it all requires attention, and it requires more things coming in the mail, more things you have to pay attention to. The only place success comes before work is in the dictionary, right?
Right. That's a good one. I've never heard that, actually. Okay, let's go to Barack Shwazori. Sorry for my pronunciation.
What number?
1132.
1132. Comment number 1132. Is that it?
Where are you tuning in from? Yes. Barack bought a property for $250K with 20% down, no PMI or tax escrow, self-employed and new business, only showing income. 2020 personal tax return isn't great. What can I do to take equity out? Thank you.
Okay, so if your tax return is not looking good, a lot of times that's true of self-employed people who have their own business, because they tend to write everything off, right? And a lot of those expenses that would normally be expenses in some part of your life can be filtered through the business. For example, like everybody, I have a cell phone, okay? And guess who pays the bill? My company. But guess what? If I didn't own a company, I'd still have a cell phone. And guess who would pay the bill? Me personally. Okay. So that's an example of an expense that you'd have anyway. But if you have your own business, you run, whatever legitimate expenses you can frankly get away with through your business, because a lot of them are these sort of businessy personal expenses, right? And you can legally run a lot of stuff through the business. So then your net income looks lower because you've run it through the business. Whereas if you get a W-2, your net is higher, but you don't get the tax deduction the business owners get. So income earned, and it's really unfair, by the way, but it's just the way it is. Life is unfair. The highest taxed income is income that people make from their W-2 job. So if you work for a company and you get a paycheck, you are getting the worst deal of anybody.
Totally unfair.
It's totally unfair. That's why
the majority of people too. I would imagine. That's
it is the majority. So everybody should have a side hustle. Okay, they should be a freelancer, an independent contractor, or have their own business on the side, so that they can allocate some of these expenses to that business. And see, as a W-2 person, you pay tax on your gross wages, and then you pay your expenses, and then you keep what's left over. Well, actually, sorry, I should have put it this way. You take your income, so say it's $100,000 a year at your job, right? You pay taxes first, then you pay your expenses, and then you get what's left over, if anything. Right? 100 grand isn't much nowadays, right? Okay. So if you own your own business and you make $100,000, you're going to deduct a bunch of expenses. Maybe there will be $30,000 in expenses. So the only reportable income is $70,000. You only pay tax on 70. You pay tax on what's left over, the net. And that's why having a business or being a contractor or a freelancer is a really good deal. And if you have a day job, a W-2 job, keep the job, but have a side hustle. And by the way, your side hustle could be your real estate investment portfolio. So your portfolio, you can allocate some of these expenses to your real estate investment business. It's a business, just like anything. And so that's a great thing. But back to the question, which that
was the first part of the question.
Yeah.
About personal tax return isn't great. What can I do to take equity out?
Yeah. So it's harder if you don't have that good tax return. And, a lot of our clients complain about this. They say, I own my own business. I write everything off. So my tax return doesn't look that good yet. They're really in reality making good money. And it's harder to qualify. Look, you got to realize something. Fannie Mae and Freddie Mac are government sponsored entities, and they require good tax returns to get their loans. They're really desirable loans. So you got to play the game and pay high taxes if you want that good tax return. But your second choice, to answer your question, is you can go to portfolio lenders, and we can refer you to those. Just reach out to us through jasonhartman.com, or at the bottom of the screen, pandemicinvesting.com, for your free mini book, which you'll get there. And our investment counselors will be happy to help you determine how you can, get with the right lender They will refer you to lenders that do asset-based loans or loans where they don't look so critically at your tax return as Fannie Mae or Freddie Mac loans, the mainstream conventional loans would. Yeah.
Very
okay.
good. Okay.
Ashley, are you ready to talk a little bit about tapering?
Absolutely. Absolutely.
Okay. Let's see if I can get this one lined up here. Whoops. Oh, I'm not ready. Isn't this terrible? Sorry. Okay, go ahead. You want to take another question, or did you do trivia yet?
No, I didn't. Let's do my trivia question.
Let me get the screen share lined up. Yeah,
let's get everyone involved and see what you think about this one.
Well, what is it?
Okay, wait. Can you pull up the slide?
Oh, I can't because I'm doing something else.
Okay,
but
not a problem.
Off your
not
side?
a problem. Yeah, it's okay. So, which member of the first Roman triumvirate made much of his wealth primarily through real estate?
Oh my gosh, that is a tough question.
We're going back to ancient Rome. It's not as hard as it sounds. Okay, we're going back to ancient Rome. Which member of the first Roman triumvirate made much of his wealth primarily through real estate?
Oh, wow. Ashley, you're asking tough questions.
Yeah, well, you have a smart audience, so I'm not worried. I know someone's going to get me.
Hey, audience. So post your answers in the comments and you will win Ashley is giving away a 2012 Ferrari. I'm just kidding, right? Yes. Are you giving that away, Ashley?
No.
Okay.
I'm keeping that.
we gotta entice people, right?
Right. You will be supplying the prize for our winner today. So
there you go. So you want to know say that again, that hard question?
Yes.
The real estate investor in Roman times is essentially.
Yes. Okay. So which member of the first Roman triumvirate, okay, made much of his wealth primarily through real estate? So think back to the Roman triumvirate. It was composed of 3 very important politicians, soldiers, generals of the time. So which member of the Roman triumvirate made much of his wealth primarily through real estate?
You have one answer already.
And we're going to talk about how he made that wealth of the Catholic Church.
That's great. That's great. So Roman real estate investors back in Roman times. Yeah. So put your answers in there. Oh, we got a few answers coming in. Okay. We've got some real students of ancient Rome.
Very good. Yeah. Very. See, I knew your audience would.
All right. Yeah. I don't know the answer to that one, but have not studied Rome that much. Okay, so let's do a little watch party here. I want to share this video. This is a Yahoo University video, Yahoo U, and I just thought it was interesting because it speaks to the tapering and the Fed's asset purchase plans, and it's completely absurd, people. I mean, the fact that we have this environment where our central bank, the Federal Reserve, in this U.S. central bank, is I am sure they've got to be the world's biggest investor. I've said that before. I actually haven't verified my own statement, but I'm just a hack, so don't take it from me, folks. That's my disclaimer. But it is absurd that they are distorting markets this way. So let's check this out and see what you think. And I'm going to have some comments about this, and then we're going to get into the tapering discussion in detail. And Ashley, just let me know if the sound works on your end on this.
Mm-hmm.
Well, Adam, on Sunday we got some details
Good.
on exactly what the Federal Reserve is buying as part of its secondary market corporate credit facility. Keep in mind, this is something that the Federal Reserve has said it would do, but just 2 weeks ago, it finally said that it was, in addition to ETF purchases, also going to take on individual corporate bonds. But
isn't this ridiculous?
Numbers look like so far. If you look at the most recent figures from its weekly balance sheet release, its holdings of corporate bonds and ETFs had ballooned to $8 billion as of just last week. That's really a drop in the bucket when you consider consider that the Federal Reserve has said it could support up to $750 billion in purchases if it needed. But nonetheless, you can see that the number of corporate bonds and ETFs that it's been holding has really been increasing. But again, as I mentioned, the Fed 2 weeks ago began buying individual corporate bonds, and we just got granular detail about what types of purchases it made yesterday. So here's what the breakdown is. Now, keep in mind, the Federal Reserve is in the process of buying these types of corporate bonds.
Okay, look at the screen here, folks. Toyota, Volkswagen, Daimler, AT&T, Apple, Verizon, GE, Ford, Comcast, and BMW. What in the world is our central bank doing buying their bonds? This is ridiculous. This is a scam of epic proportions. And last year, it became dramatically worse. They started buying up everything. Like, what business is it of this private corporation, the Federal Reserve, that is like this with the government, although it's not a government agency? In fact, a funny saying they have is the Federal Reserve is about as federal as Federal Express. Okay, this is a company. It's a corporation, and it's a mystery who really owns it. Nobody really knows. It's like a big conspiracy, mystery. And what in the heck are they doing? Buying bonds of these companies. They are selecting winners and losers, because what you don't see is the companies they didn't buy the bonds of. Now, how do you get the Fed to buy your bonds? Okay, and let's just understand what that really means. If you're Toyota, a foreign corporation, even not even an American company, or Volkswagen, for example, or Daimler, right? If you're one of these companies, you want the Fed to buy your bonds, because that'll push the price of your bonds up, and it'll push the yield on those bonds down. So, in other words, those are inverse. Just always understand that. When the price of the bond is higher, the yield is lower. Why is that? Well, because if you buy a bond and the bond yields, say, 5%, the interest rates are so artificially low and fake, I don't even want to go into that. But if a bond yields 5%, and you pay more money for that bond, and it has the same yield, that means the yield goes down because you had to pay more for it to buy that bond. Remember, a bond is just the flip side of a loan. Like when we talked earlier about that big mortgage pool that the bank might own, well, those are essentially bonds, right? If they sold them off on the market, they could sell them as bonds. They securitize them as bonds, mortgage-backed securities. So, the higher they pay for the bond, the more the yield goes down. So the Fed steps into the market, starts buying all the bonds of these companies, which is hugely beneficial to the company, because now they have more money that they can go invest with, pay their crooked executives with, go out and buy other companies with, whatever they want to do, expand their operations. And they push the price of the bonds up for all the little investors in the market who want to buy those bonds. Okay, so it's just a complete distortion. It's a total scam. And then the question is, what do you have to do to get the Fed to buy your bonds? Oh, I'm sure there's got to be some favoritism going on there. Does Toyota and Volkswagen, Daimler, AT&T, Apple, etc., do their lobbyists hand bags of cash to Jerome Powell, at the Federal Reserve? I don't know. How does the Fed decide which bonds it wants to buy and which ones it's going to ignore and not buy? This is a totally unlevel playing field. It's ridiculous. The Fed should not be doing this, but hey, it is the way it is. Okay. Anyway, let's keep listening.
Can you turn the volume up?
Yeah. No, I don't think it's up all the way. My volume control won't influence it. So you can hear it though, right?
I can hear it.
Yeah. Okay. Oh, shoot. We missed. Okay. So here we are, the bond buying.
Nonetheless, you can see that the number of detail about but this is the Fed index,
yeah.
called the broad market index that the Fed at some point aspires to have its corporate holdings to look like. So as of June 5th, this is what it would like its index to look like. And you can see the big names here are companies that you should be familiar with, names like Toyota, Volkswagen, Daimler, a lot of car companies on here. AT&T, Apple, Verizon, which by the way is the holding company for Yahoo Finance, also on this list here. These are all substantially large companies that the Federal Reserve could be buying corporate debt in over the next few weeks. Keep in mind, though, these are just the top 10 holdings. The whole list, which the Fed has published on the New York Fed website, includes 794 companies. So yes, these are just the top 10 by holdings, but there are hundreds of other companies that could be part of the Fed's portfolio as well. The Fed had
794 companies. So this private corporation that is in bed with our government is buying the bonds of 794 companies. This is ridiculous, folks. You just can't make this stuff up. There is so much favoritism and backdoor dealings going on. It's just completely ridiculous.
I said, however, that it will refresh this list every 4 to 5 weeks, so it's definitely worth keeping an eye on all of this. Now, one important note is, okay, well, is the Federal Reserve going to be buying junk companies as part of this, as you mentioned? The answer is partially yes. So if you break it down by credit rating, a double B, which does represent junk bond rating, is only 2.8% of the index that it hopes to have. Over 90%, that means, is going to be in either well-rated AAA to single A rated debt, or what they call investment grade, which would be triple B rated debt. That actually makes up most of the index here. So this is what the composition of the Federal Reserve index as they aspire to have it. But keep in mind, this is something we're going to need to closely watch as we do go through some of the other leaks of this secondary market corporate credit facility. So again, the Federal Reserve dipping into this, but something that needs to be closely watched over the coming weeks.
Okay, now, do you think this guy is he likes tennis shoes back here? Look at this.
Oh yeah, I see that.
Who puts their shoes up like that and has them on boxes? I don't know. It's just funny. It's funny coming into everybody's home, isn't it?
It
like
is
nowadays.
It is.
You know, it's just
by
weird.
funny you mean uncomfortable.
Yeah, it's weird. So if you want to schmooze this reporter, you buy him some Air Jordans, okay?
Sure. The guitar, yeah.
Yeah, that's the way to do it. You
like
can tell what he's into, right? Totally.
Grandmother had a word for that kind of, these what might be junk, which was treif. In Yiddish, it means not so kosher. But let's shift to something else. Is the Fed shifting from ETFs to individual corporate bonds, or do we have a sense of where they're headed?
Yeah, well, when they first announced this program, the first thing that it did was buying ETFs. So junk bond ETFs, investment grade ETFs, a lot of them put together by Vanguard or BlackRock, which, by the way, is one of the advisors to this whole program for the Federal Reserve. But
oh, how convenient. So Vanguard and BlackRock are advising the Fed to buy their own stuff they're selling. Oh, there's no conflict of interest there.
Not at all.
Yeah. It's just unbelievable. What happens at the highest levels of our financial system is a total freaking scam. Total scam.
It's incredible. There's just no accountability anymore.
Yeah, it's just unbelievable.
And
this is all your money. One of the ways the Fed gets your money is they inflate away the value of it. Okay. That's the way they're stealing from you. One of the many ways. So yeah, it's just ridiculous. So this has been going on for over 100 years, started in 1913 on an island in Georgia. And I took my mastermind group to this island. It's called Jekyll Island, and a famous book written about it by a man who has been on my show many times and spoken at a couple of our events, G. Edward Griffin. He wrote a book called The Creature from Jekyll Island. It's a great book, folks. I'm sure many people watching and listening have heard of it. But yeah. Anyway, so what is the taper question, right? That's really the thing you were asking, Ashley. Mm-hmm. What is tapering? Well, tapering just means to make smaller, right? So I'm overdue for a haircut. And one of the things the hairstylist always asks when I go in is, do you want the back tapered, right? So, do you want it to come in like this or be like that? I don't like it tapered. Okay. So I don't like tapering and neither do the financial markets. And so what they mean by tapering today, but it could mean different things at different times. And I'm going to give you an example of that is today is they're talking about tapering the asset purchase program of the Fed. So many of the assets they purchase are mortgage-backed securities, MBSs, mortgage-backed securities. And those mortgage-backed securities basically allow more mortgage loans to be made. So if the Fed reduces their purchasing, then that is going to cause the mortgage market to slow, and they're not going to have as many loans to offer. And so some think that will put a damper on the real estate market. And they might be right to some extent. I don't think it'll be any big deal because there are certainly lots of other buyers for mortgage-backed securities, not just the Fed. Okay. And it may cause the price of those securities to go down a little bit, which means the yield will be more attractive to buyers, right? And so this is what happens. It's a marketplace. So the more buyers there are, the more money there is that want to buy those mortgage-backed securities. The higher the price, the lower the yield. And so that could be a thing, right? It could also cause the stock market to decline. It could cause every market because basically the Fed is acting as a big buyer, and that big buyer creates demand and buoys the prices. It artificially runs up the prices of these assets. So when they're talking about tapering today, they're talking about reducing the investment in these assets, these ETFs, these bonds, the mortgage-backed securities, even stock. Yes, even stock. Okay. So the Fed buying equities in the stock market, buying, Apple stock, for example, not just their bonds. Companies sell they sell many things. They sell products to consumers, right? So Apple sells these things, right? And people buy them, but they also sell bonds, their debt, right? And they also sell stock, their equity on the markets. So if the Fed reduces or tapers its asset purchase program, then it could cause these assets to decline and could slow down the economy. Okay. That's what they're talking about with tapering today. But in the past, the big talk about tapering was mostly about QE or quantitative easing. Now, that's not exactly money creation and money printing, but part of it is. So essentially, the Fed controls how much money banks can lend, how cheaply they can lend that money, and thereby they control the interest rates. So they control the reserve ratio. So, for example, they might say that banks have to reserve X percentage of their money, and they can only loan out X percentage, right? A certain percent. And that would represent quantitative tightening, a tightening of the money supply by saying to the banks, look, you can't loan so much money out. We're concerned that there are going to be defaults, and we're also concerned about inflation. So we want to tighten and constrict the credit supply. And we have many tools to do that. We will reduce the purchase of mortgage bonds, right? That'll reduce the amount of available credit. We will increase the discount rate. We will increase the reserve ratio. There are many tools they can use to reduce the amount of credit in the market. And then their relationship with the government and specifically the Treasury Department influences how much actual money is in the system. Now, most of that money nowadays is not printed, although we still call it money printing. It's really just created electronically. And it is lent into existence. This is one of the hardest things for people to get their head around. And it was hard for me to get my head around, 16, 17 years ago when I really started studying this. I took economics in college, but, the real lesson in economics was just my own self-interest and my own curiosity and reading books and learning about it. And one of the hardest things to understand, to really understand, and I still don't know if I even understand it today completely, and any honest economist will say that same thing, is how money is lent into existence. Okay. So, for more information on that, it is a rabbit hole. And if you think you understand it, you probably don't. Okay. Because there's a lot to it, there are many nuances to it. But just listen to my Creating Wealth podcast. And I have interviewed thousands of experts on topics like this. And it's all free. So, the Creating Wealth Show, wherever you get your podcast, can teach you a lot about this stuff. And it is really, really fascinating stuff for sure. So, yeah. So that's tapering, and they could be tapering anything: asset purchases, money supply, quantitative easing, whatever. Okay. So they can taper anything. And today, if I get a haircut today, if I have time, they will ask me if I want the taper. And I'm going to say, no, don't
Throw
taper.
a tantrum. No,
Tantrum, a taper tantrum. And by the way, Ashley, the taper tantrum comes from this: the economy and the financial markets and Wall Street throws a tantrum because they don't want the Fed to taper, because that's the equivalent of being at a party and the bar closing. Okay, last call, no more, last call. We're taking away the punch bowl. The party is ending, right? Yeah. That's the taper. Okay. So that's no fun. We want to keep the party going, keep the drinks flowing, open bar, let everybody get totally drunk. But at some point, the bar has to close. And then if you indulge too much, if you imbibe too much, what do you have the next day?
A really bad hangover.
Yeah. And that's what the economy will have. And that hangover, Ashley, is essentially what the Austrian economists taught us about. It's the business cycle. That is the hangover. Sometimes the business cycle is soft. You go out, you have a few drinks, you have fun, it's a good time, but you don't overindulge. Sometimes it's New Year's Eve or you're celebrating something big, you overindulge and you regret it the next day. We've all been there probably. So that's the economy does the same thing.
Didn't they try this in 2018 and then immediately kind of reverse course?
Oh, they're trying it all the time.
Right. But
absolutely. Yes, they did. And they're constantly doing it. There are little parts where they're doing it, and there are big pronounced examples of it, like during the Great Recession back in 2008. Huge example where the Fed's balance sheet went crazy. They were buying assets, they were printing money, they were QE, everything QE to infinity, quantitative easing to infinity, to infinity and beyond, as Buzz Lightyear said. And then last year it started again when we were really hit with COVID 1984. So there you go. Hope that explains it, folks. If you have questions or thoughts on tapering, put them in the comments below. And by the way, I'd love to know what you think. Do you think the Fed should taper? If your answer is yes, that means you're not having a tantrum. If your answer is no way, you're having a tantrum. So tell us what you think. Comment below.
What kind of timeline are we looking at for this?
Well, it varies in terms of time and degree. The Fed, the Fed talks in hieroglyphics. They talk in code. And, there's an excuse for that. Like, they justify it by saying, look, if we just come out and say we're going to do this or we're going to do that, the market will react and everybody will dump the assets. And we don't want that to happen because it would be too severe, right? So basically what happens is they kind of give a hint and they talk in code. And that's why when Jerome Powell speaks, the Federal Reserve Chair, people analyze what he says, like every word, every expression, because what he says has so much impact on the markets, both domestically and abroad. The whole world reacts to it. All markets, the Hang Seng Index reacts to it. The Chinese stock markets, the stock market in every country reacts to it, as well as our own, of course. And so he doesn't come out and exactly say things. And then they publish something. The Fed publishes what they call their beige book. Yeah, that's what it's actually called, the beige book. I think they publish that quarterly, if I'm not mistaken, the beige book. And, it tells about what the Fed is going to do and what they're thinking. And there are armies of analysts, people who spend their whole career trying to analyze what the Fed is going to do. Now, I will say that Jerome Powell, our current Federal Reserve chair, is more obvious as to what he's going to do in his statements than certainly the one who would be the complete diametric opposite of him was our old Fed chair, Alan Greenspan. Alan Greenspan, I mean, nobody knew what he was saying. There were people that just like, does he mean this or does he mean that? They would really just, he would talk in code. Alan Greenspan, you never knew what he was exactly thinking. Jerome Powell, he kind of wears his heart on his sleeve more than other. He wears his wallet on his sleeve. I guess is the right thing. So he's not as mysterious as Greenspan, but they're still all mysterious to some extent. And they have a reason for that. Their reasoning is that they don't want the markets to overreact, right? So, but the truth is that this is why it is such a scam. Well, one of many reasons is that the insiders, they go have lunch with Jerome Powell. Okay, the people at BlackRock and Blackstone and Goldman Sachs, they're advisors to him. Okay, they play golf together, so they have the inside track before he makes a speech, or before the FOMC, the Open Market Committee, the Federal Reserve's Open Market Committee, does anything, they know and they react in advance. So it's totally unfair. It's whenever you have these institutions and these systems, you're going to have all sorts of insider trading, if you will. It's basically insider trading. Yeah.
Sure. Great comment from Jason Kincaid. Hi, Jason.
What number?
1206. It doesn't matter at this point. $500 trillion in future debt obligations. Retirement accounts are gutted. All social programs are gutted. The pooch can't take anymore.
Screw the pooch, as the saying goes, right? Yeah. No, you're right. It is really, Jason, the problem is we are in such uncharted territory that we don't know how long they can keep doing this, how long they can kick the can down the road. Nobody's ever been here before. It's totally new territory. So, you say the pooch can't take anymore, but the pooch might be able to take it for 10 more years or 50 more years or 100 more years. How long can the system last? One thing we know for sure, it cannot last forever. But will it end tomorrow? Certainly not. Sure. It can probably last a lot longer than most of us think. Look, way back, starting in like the 70s, probably, there was a guy named Howard Ruff. And I interviewed Howard Ruff, who passed away, but I interviewed him on my show several years ago. And Howard Ruff is one example of many. The modern day Howard Ruff might be considered Peter Schiff. Okay. And all of these people have been predicting the end for decades. And guess what? It never happens. Why does it never happen? Because none of them know how long they can keep playing this game. You just don't know. It is an unknown. We have never been here before. Yes, it does have to end at some point, but if you're banking on an ending anytime soon, I would be very careful with that bet. That is not a trade I would make. Don't look for any currency collapse anytime soon. Don't look for Bitcoin to take over the world. Don't look for the U.S. to lose its reserve currency status or the dollar to lose its reserve currency status anytime soon, folks. It just ain't happening.
We'll see.
And Yeah, and Ashley, I'll tell you, you know what I'm gonna say when I say this. Why isn't it happening? Well, my answer is aircraft carriers and nuclear missiles.
Mhm.
Standing armies will not allow the dollar to lose its reserve currency status. They will not allow Bitcoin or any cryptocurrency to take over the world. Just none of this stuff is going to happen, folks. What is going to happen, I can tell you what is going to happen for sure. Inflation, and very likely, which by the way, I predicted this back in the middle of February of last year, stagflation,
Mhm.
inflation's ugly cousin. And stagflation just means inflation with high unemployment. Now, the unemployment numbers are so manipulated that we don't really know what the unemployment rate is, but it's higher than they tell us. I think we can agree on that. And then there's the aspect of underemployment and what that employment looks like. I mean, just because you have a job doesn't mean it's the right job, where your best fit is, where your earning potential is at its highest point, or it's the job you want, that you're interested in, or that you're working full time. I mean, when stupid Obamacare came along, lots of major companies cut their employees' hours from 40 hours a week to less than 32 hours a week, because that was the point at which you had to cover the Obamacare mandates.
Mhm.
People were employed, but they were underemployed. So underemployment is a big problem. When
Sure.
you see people with college degrees working at Walmart or doing menial jobs or delivering my pizza, you got a problem. Okay. And I give you just one example of that. I remember, and I posted this on Facebook, another big scammy company, uh, years ago. This was when I lived in Scottsdale, Arizona. And I remember I got in an Uber, and, I like to talk to the Uber drivers sometimes. And I asked this guy, we got to talking about the economy or something. And I said, well, you know a lot about this stuff. What did you do before? And he says, oh, I worked on Wall Street. And I said, really? And he said, yeah. What do you do? Well, I was a bond trader. A
Hmm.
bond trader. I mean, some of those guys make a ton of money. And here he is driving an Uber car, right? I mean, it shows you that the economy is not allocating resources correctly when you see that kind of stuff. People are underemployed, and they shouldn't be underemployed. I'll give you one other example. I remember I hired a driver. It wasn't Uber, but it was like a hired car service once to pick me up. This was when I lived in Southern California, to pick me up at Long Beach Airport and drive me to Newport Coast, where I lived at the time. And I got to talking to him. I'm in the back of the limo, and I'm talking to the guy, and he says that what he used to do before he was a driver is he was an industrial engineer. And he used to work a lot with these companies and their big manufacturing plants, and he would decide what equipment they needed, what processes they should implement. Now, do you think he made more money doing that than driving a town car? I mean, it's just, yeah, a lot of people underemployed, even when the job numbers won't show you that. Okay.
Mhm. Right. Well, thank you, All Nighter Hider, for reminding us to hit the like button at 1208. The like button is a bankster. Go hit it.
There you go. Thank you, All Nighter Hider. It's good to see you back, by the way. I don't think you've been here the last couple of times. I was thinking about you.
So go back to 1157. So we have this great question from JBL.
All right. JBL, is that like the speakers?
That's what I can't think of anything else. JBL.
Okay. What comment number 1157?
Yes.
Wait, no, that's not it. Here it is, probably.
The previous.
There you go.
There we go. Quick question. I know everyone is saying we are in an hyperinflation environment now, but do you believe we will eventually transition to a deflation environment?
Oh, this is the argument of the ages, folks. There are a small number of economists who believe deflation is coming. I'm not one of them. And could you? I mean, look, there are some who say inflation now, deflation later. Some say deflation, then inflation. The predictions are all over the board. Nobody knows for sure, obviously. But you just ask yourself, what would cause deflation? Well, you would have to have a major loss in confidence in the economic structure, the currency, etc. And you would also have to have a huge constriction of the money supply. Now, I want you to remember something when you look at the money supply. The money supply isn't just about money or currency. We really should say currency. Money is the wrong word. Money implies that something has intrinsic value. Currency is just paper. It's really not exactly paper, by the way, either. Go down that rabbit hole if you want and see how the bills are made. It's pretty interesting. But a tightening, a constriction of the money supply or the currency supply, but it's also the supply of credit. Okay, so what would cause that? Well, loss of confidence, loss of investment in credit-oriented securities, fear of the future, fear of high inflation would cause a credit constriction because, of course, lenders would be paid back in cheaper dollars. And that's my whole philosophy of inflation-induced debt destruction. So it could happen, but I tell you, I don't think it's extremely likely because things have been so pumped up. In fact, I think the inflationary possibility is much more likely because we have so much currency that hasn't even hit the system yet, right? A lot of it hasn't trickled down to the spenders. And when it trickles to those spenders and they start spending that currency, that is going to cause a lot more inflationary pressure than we already have. Also, one prediction I've made that I haven't heard anybody else making is that all these homeowners, owner-occupant homeowners, and investor owners that own rental properties that have taken advantage of these artificially cheap mortgages, they will be unlikely to part with those super cheap mortgages when interest rates rise, and they have to inevitably rise, and they will not be wanting to part with those properties because they have such good mortgages attached to them. It's like a huge asset attached to the property. And that will cause a scarcity of real estate supply, which will create inflationary pressure in those real estate assets as well. So I don't know. I mean, yes, we could have deflation, of course. We could have small bouts of it at certain times, but the likely big overall trend is very much inflation, in my opinion.
Speaking of jobs, JBL, I love this comment at 1214. The young generation doesn't even want to work, produce, build anything. They all want to be bloggers, YouTubers, influencers. Yes.
Yeah. And guess what? That's not real, folks. That is smoke and mirrors. That's 1114.
Doing it. 1214, also from JBL.
Oh, 1214. Okay.
We were talking about jobs.
Yeah.
And we were talking about college grads doing jobs that are, they're overqualified to do.
Yeah, that's a really good point. Really good point. No question about it. Yeah. Good stuff. Okay. Oh yeah, here it is. Sorry, I'm a little slow on that one. I was looking for it. Yep, you are right. And you can't all, and not everybody can be an influencer or a blogger. Someone has to actually make the widgets, folks. That's how a real economy works. There are hard items that need to be produced, right? Look at this stuff around me. It's all not made by a blogger or a YouTuber.
Yeah. People are doing it and people are successful at it and making money. And so a lot of the younger generation are growing up and seeing that. And that's, they're aspiring towards that. And it's kind of, it would be a dream come true.
Yeah, it's looked at as the easy way, right? It's still a lot of work. But before we wrap up, Ashley, and I know we got a few minutes, but I just want to say, be sure to go to pandemicinvesting.com and get a free copy of my mini book there. Totally 100%. 100% free, no strings attached, pandemicinvesting.com. And what we've done is we've taken a lot of the strategies that I've been teaching for the past 18 years or so, and we adapted them for the crazy world we are living in now. And you can get that totally free at pandemicinvesting.com. Also, we have a new thing that I have not mentioned on the live stream before, but and I don't have a thing to put this on the screen, but our software, Property Tracker, which is our flagship SaaS software, web-based software that helps you analyze and evaluate and track real estate deals. So once you own them, it will help you keep track of your properties in your portfolio, and it'll help you evaluate whether or not you should buy them in the first place. We now have a free version of Property Tracker. So just go to propertytracker.com. You can sign up for a free account. How much is it? Free. Okay. How much is it? $0. Free. Totally free version of Property Tracker now. So we're super excited to offer that. We still have the paid version, which has more features, but there's a free version that does a lot of cool stuff. So just go to propertytracker.com to get that. And then the free book is at pandemicinvesting.com. And also Empowered Investor Live. That is coming up. Get tickets for it at empoweredinvestor.com. So sorry to give you so much to do. I know your fingers are typing all over. You're going all over the internet, but just some good resources for you. Okay, Ashley, you got more questions or comments?
Yes. So we
Did
have.
you answer the trivia yet, by the way?
No, I didn't answer the trivia.
I can probably pull that slide up.
Sure. Pull it up. Yes.
Okay.
And we will answer the trivia question. So which member of the first Roman triumvirate made much of his wealth primarily through real estate? So real estate investing was a big deal back in ancient Rome. A lot of people made a lot of money.
Do you see that? Okay, yeah. It's not coming up the normal way. Okay, I did something a little weird. There you go. Okay, so here is not, we got to get to the trivia question answer. I suppose it's, where is it?
It is. Okay, so that's the question. Okay. All right, and so we had a few answers. We had the Roman Catholic Church. No, unfortunately, they were not a member of the first triumvirate. We had a couple people mentioned Julius Caesar. Yes, he was a member, but he did not make much of his wealth through real estate. A few people answered Pompey.
Ashley, by the way, where are we? What number range are you in now when you're talking about these? Give me one number.
I don't have them.
Okay.
I was just remembering. One more.
Okay, well, we know I got some. So we got Brutus.
Yes, no.
Yeah, okay.
Caesar, and a few people answered correctly by saying Marcus Crassus.
Oh, so Marcus, right?
Crassus, yeah. So go to the next slide.
Okay, all right.
So
there you go.
Marcus Licinius Crassus, born in 115 BC, died 53 BC. So he made his money a lot of different ways. Slave trafficking, silver mines. He had a lot of silver mines. Speculative real estate purchases.
I wonder what the price of silver was back then.
I was interested actually in that too. He would buy up properties very cheap after when they were being auctioned off. They were confiscated in proscriptions from the dictator at the time, Sulla, and he bought a lot of property at a very discounted rate from that situation. And also, but he was, very smart. He created a workforce of over 500 slaves, slaves that had skills, highly skilled architects, builders, and he would use this workforce to rebuild a lot of his properties. He would buy up things that had burnt down, things that were just falling down, and he would rebuild them. And he also did another thing, and he was, this is a bit suspect. He he had the first.
We're not saying he was a good guy. He was just a
No,
real
we're not. No, he made a lot of money, but so in quotes there, the first ever Roman fire brigade was created by Crassus. Okay. Fires were almost a daily occurrence in Rome because people were just living on top of each other in very close quarters with open fires. And Crassus took advantage of the fact that Rome had no fire department. He created his own brigade, 500 men strong, which rushed to burning buildings at the first cry of alarm. Upon arriving at the scene, however, the firefighters did nothing, while Crassus offered to buy the burning building from the distressed property owner at a miserable price. He would also offer, the neighboring buildings. Obviously, the value of the neighborhood certainly went down. And he would offer to buy up their properties. And if the owner agreed to sell the property, the men would put out the fire, maybe salvaging some things. If the owner refused, then they would simply let the structure burn to the ground. And he bought a lot of properties this way. He rebuilt them and then he leased them often back to their original owners or to new tenants.
Unbelievable. Ashley, that's quite a history lesson.
Interesting, though,
But I don't think you're finished yet, right?
No,
Plutarch.
I'm not. Plutarch. So Marcus Crassus is known as we call him the richest man in Rome. Everybody says that, the richest man in Rome. But, how much was he worth? And so it's of course it's hard to say exactly, but Plutarch in his Life of Crassus says the wealth of Crassus increased from less than 300 talents at first to 7,100 talents.
Wow.
This, okay, we need to put it into, modern equivalent that we can understand. This represented 229 tons of gold, or about 7.4 million troy ounces, worth about $13.3 billion at July 2021 gold prices.
Not bad. So I'm guessing that would place him on the Forbes 400 richest people in America.
It's incredible. Yeah.
He'd probably be, so with $13.3 billion, where would you be on the Forbes 400? I'm guessing that would be like number 120 or something like that. I mean, now these numbers are so astronomical with Bezos and Buffett and Gates and all the rest. But wow, he's probably richer than Richard Branson, I think.
And that was 2,000 years ago.
I should have said Elon Musk. He's the richest now. Yeah.
Thank you, JBL. That's exactly my point. JBL. 1-2-25. Slaves, labor, and real estate. Okay, so the same methods as of today. It is the same as how titans make wealth today.
Yeah, you know what? That's a good point. You're right. They do. Big and Bezos basically has enslaved his workforce, where they've got to wear monitors on them. They won't let people talk in the warehouses. It's just unbelievable. But what he's done is, of course, super smart. And one of the many ways it's super smart is he's made the consumers, which are the largest number of people, like the company, right? Because they're a very consumer-centric company. So, you get fast deliveries, everything's cheap, easy return policy, all that stuff. But he abuses the workers, right? So there's fewer workers than there are consumers. Mm-hmm. So that's a good plan not to be attacked, right? And if you look at the way Google cheats, all these companies cheat in so many ways. It's absolutely appalling. But, Google tries to get away with their antitrust violations by being in all these different businesses. They've got a robotics business, they've got a self-driving car business, they got all these businesses, right? But the reality is they make all their money in search, like advertising, selling ads on search, right? That's pretty much it. Everything else is a loser. And all those things are just diversions. So when the federal government is knocking on their door saying, look, you're violating antitrust laws. What do you mean? We're not in the search business. We're in all these businesses. We don't dominate all of them, So it's just these companies are the robber barons of our era. They are the Carnegies, Mellons, Rockefellers, and Vanderbilts of our time. They're abusing the system. And by the way, a good word for you to look up, folks, if you don't understand what this phrase I'm about to say means, a lot of people don't. It's not used that commonly. Rent seeking. Look up the term rent seeking and really ponder how that is used by especially these large companies. They are rent seeking like crazy. It's not like real estate. Okay. It's not about that. Rent seeking. Look it up. It's really important to understand that concept. Okay, Ashley, thank you so much for the trivia lesson. That was excellent. Folks, give Ashley a hand. And that was a hard one, I think, but a lot of people actually knew. I didn't know. Yeah.
It just goes to show every age has its robber barons. So
definitely
every
does.
age.
Hey, folks, we got to make a deal with Ashley here. Every time we do a live stream like this, before she presents the trivia question, she has to tell me the answer.
I know that one, but
yeah, you got to tell me the answer so I don't appear so clueless.
I've only been able to stump Jason a few times.
Yeah,
in the trivia is pretty smart.
Good stuff, good stuff. Okay, so anything else before we go?
That's it. Let's wrap it up. And thank you so much for joining us. Hit the like button, subscribe, get the notifications, do all the things. You know what it is,
folks. And go to empoweredinvestor.com. I'll just put that back on the screen for just a second. Let me get it here.
Exactly. This is exactly. Crassus's fire brigade were probably arsonists. Yes, exactly.
Yeah.
Most likely they were setting the fires and then showing up to then offer a very, a miserable price for the property.
That's exactly what our government does today.
Exactly.
They create a problem and then they come in and solve it for us. And we're so glad, we're so relieved that the cavalry has arrived and they're going to solve our problems. Yeah.
Thank you, Chris Six Strings, for that. That's exactly the point. Yeah. Very good.
So come see us live in Orlando, September 10th through the 12th. We've got a property tour on Friday the 10th, and then a conference all day Saturday and Sunday. And you will just love it. Everybody loves our live events. We haven't had one in a while. Go to empoweredinvestor.com, get your tickets, and we will look forward to seeing you there. And Ashley, thanks so much for helping out today and hosting.
Thank you. My pleasure.
Bye, everybody.
Bye-bye.